Yeah, so we'll just kind of dive in. If you guys have done, I've done a couple of themed webinars last week, this week. This week, we're going to take a little bit deeper dive into what's coming down the pipeline so we can all expect it. And that's perfect, Greg. And then, and then from there, we'll just kind of dive in, answer questions and stuff like that too. And just kind of want to show you some of the stuff that's coming down the pipeline. So first of all, welcome to everyone. So the first thing is that I think we all can agree with is that the markets have been a little crazy. And there's this great, one of the emails that we had sent out for this, we'd found this great meme. I should have included in here, but it had a picture of Donald Trump holding up a sign that said, "Your technical analysis is no match for my tweets." And that's how these markets have felt for a lot of folks, where it's like, oh my gosh, rallies one day, down the next, rallies the next day, down the next, and it makes it seem fairly chaotic. Okay. Um, and the headlines are going to continue to get worse and worse for a couple reasons I'm going to show you. And we just kind of want to dive into that. Now, the first thing to keep in mind is that when a market is in a nice steady uptrend, that is also the easiest time to trade. This is a snapshot from an account that I set up with $5,000 at the beginning of the year. And here it was at the end of March. And you can see here that the P&L went from 5,000 to 25,000, and it basically kind of mimicked the market, right? It's like, okay, well, the market was going up and this was going up. Obviously, I wasn't fighting the trend. I was timing the trades right and things like that too, but it was also specific market conditions. So the question is, well, what about now? The markets are crazy right now. Does this mean that it should be harder? And I guess I would just say that no, this can be easier if you know what to look for. And at this point, you can see it. And in June, my account was sitting, this is for the trading room, around 250,000. And then my biggest trading day of the year so far was on this day, and that was good for $80,000. Now, if you have a smaller account, that's fine. It just means you'd have smaller positions on in place. So, if you had a $5,000 account, this particular day, I think the account was up like 25%. So if you had a 10K account and you're in these positions, then you would still make the same percentage move. But the point is that this is something where the markets were going down, but the equity curve kept making higher highs. And here, as of end of last week, I was at 401,000. At the end of today, August 28th, it's at 423,000. So it continues to climb throughout this volatility. Obviously not straight up. There's going to be pullbacks and things like that. So the main point with this is simply understanding that just because the markets are different, just because the markets are crazy, does not mean that they have to be hard. It certainly doesn't mean that every trade's going to work, but it doesn't mean that you can't take advantage of the chaos either. So right now, what we're going to talk about today, what you'll discover today, is that the markets right now seem crazy, right? So we've got trade wars, we've got tweets, we've got volatility. It's easy to lose confidence during situations where everything seems so random and so out of the blue. But the reality is there is a trade for every market. There is a trade for every market condition. And the first most important thing to keep in mind during a situation like this is just to kind of understand that, when you're getting your information from the financial press, they're going to tell you things that make you stick around for the commercials, okay? That doesn't necessarily mean it's going to have any resemblance to reality. Okay, so just kind of keep that in mind. The financial press, whereas you think that they're there to help you, they're there to sell commercials. All right, so and if their main goal is to sell commercials, of course, then they're not, they don't really care if you make money or not. So the bigger question is who is right? Because there's conflicting headlines going on out there. Are we headed towards some kind of implosion like the 2008 financial crisis? Is China going to dump our bonds? Is Trump going to save the market? Okay. First of all, it doesn't matter. Okay. Whatever happens with the markets, as long as you've got clear signals, you can take advantage of the movement in a variety of asset classes. Okay. So the way to look at this is with setups and to have a plan that addresses these market conditions. Okay. Because you can't trade the market right now like you did back in Q1. It just won't work. So don't get wrapped up into the drama. Instead, we just want to look at the facts. Okay. So what are the facts right now? What are we up against? Well, in 2016 and 17, global debt actually declined a little bit. And all of a sudden, we were on the path to starting to reduce global debt. Well, that came to a screeching halt over the last year. Global debt has now reached a new all-time record of $247 trillion. Okay, that is a large number to keep in mind because, first of all, it's never going to get paid off. Okay, it's just going to have to be managed. And if we cannot inflate our way out of this mess, which is how it's happened in the past, how is the world going to deal with it? That's going to answer a huge, huge question. So we want to keep that in mind. So first thing there. Next, negative debt is at an all-time high. Okay, what does negative debt mean? If you start hearing the concept of negative yields, this is basically when you buy a bond that has a negative yield, it means that you lose money on it. So you put $100,000 into a bond at a negative 1% yield. At the end of its maturity, you get $99,000 back. Okay? Think of the implications of that. It's insane. And here's where the major negative yields are. Okay, you've got, of course, right now the US has some of the better yields in the developing world. UK is slightly positive. Japan, negative interest rates. Germany, negative interest rates. France, negative interest rates. Netherlands, negative interest rates. Switzerland, negative interest rates. Spain's next. New Zealand just cut by 1%, and it was a surprise move. They were not expecting it. All right, so look for these to continue to go lower. Okay. Bankers stunned as negative rates sweep across Danish mortgages. So for the first time ever, we're getting mortgages out there with negative amortization tables. What does this mean? This means banks would rather loan out money at negative interest rates than keep it and do nothing with it. Okay? Think about the implications of that. Think about the implications of that. So negative yields. So negative yields is basically, instead of, say, if you had a checking account earning 1%, what if you had a checking account that earned minus 1%? Okay, so if you had $100,000 every year, they would take $1,000 out of your account. Guess what? That's exactly what's happening in Switzerland right now. Okay, it's insanity. Here's the problem with negative yields. Okay, Japan did this first. Europe joined the party in 2014. They thought that once they went into negative yields, that it would cause this explosion, this firecracker of economic growth. And once that growth happened, then they could start to raise rates to contain the growth. But the problem is that it didn't happen. And once you go into negative rates, it is almost impossible to get out. In addition to going into negative into negative rates, the yield curve inversion is happening right now, and this has always led to recession. Most notably, this is when the 10 and the 2 went negative in 2007. What happened after that? Recession. Happened again in 1999-2000. What happened after that? Recession. Happened again 1988. What happened after that? Recession, et cetera, et cetera. Guess what? We're just dipping into that again. In fact, the 10-year 3-month yield curve, and this is from today's close, is now more inverted than it was in 2007. Of course, as we all know, when that happened in 2007, shortly thereafter that, the financial crisis hit. Okay. Last but not least, the yield curve is pricing in a new president for 2020. Again, this is not political. This is just talking about what the markets are doing. Once the midterm elections happened and Democrats won the House, this has been falling. It's basically pricing in a new president for 2020 and an accompanying economic disaster. All right. The markets see all this happening before everybody else. And again, it's fascinating to see. And as long as you're aware of it, you can take advantage of it. So the global slowdown is also real, with global PMI dipping below 50 for the first time since 2012. And in fact, the only economies right now that are expanding are the US, Brazil, and India. okay? So India expanding the most, followed by the US, followed by Brazil, as all indicated by the PMI being over 50. Everyone else here is contracting and Germany is plummeting, okay? Germany is plummeting. You can see that world PMI is also dipping into recession territory. Now, it doesn't feel like it because in the US, real estate's doing great. A lot of businesses are doing great. In fact, we've got decent growth in the US. But the problem is when the world sneezes, the US catches a cold, okay? And this is all foreshadowing bigger things to come that we want to be aware of. Yeah, India's rocking, right? So, and now here's the other conventional wisdom that we're seeing in the press is that Trump will do whatever it takes to save this market, including pressuring the Fed to reduce interest rates. Well, I've got some news for you. The market is now already pricing in 4 to 5 more 25 basis point Fed rate cuts, targeting 0.95%. Okay, think of it this way. This is already priced in. Okay, for the next meeting on September 18th, it's already priced in. So the idea that they're going to cut rates by a quarter point and save the market is a complete and utter fantasy. Okay, the markets have already priced it in. So at the end of the day, uncertainty and chaos equal life-changing moves. So I think everyone here would agree that the financial markets are the #1 place to create extra income and build wealth without a lot of overhead or having your money tied up in illiquid assets. However, it can be a really tough situation in this kind of environment if you don't know either A, if you've never faced this situation before, or B, just knew what to look for. But it's very possible to trade. You got to kind of crack the code to being able to trade successfully in any market condition and be able to recognize when there's big seismic shifts heading towards you like a freight train, okay? I mean, let's face it, we're all pretty smart in an uptrend, but what happens when the market changes? And what other kind of market environments are there that we should be aware of, okay? Well, at the end of the day, what we're facing here is a once in a decade, possibly once in a lifetime opportunity to take advantage of essentially chaos, and chaos equals big moves, okay? Big moves. Amara is asking, do you have any indicators that could tell us when the next Trump tweet would be? I think it would be great if he would start a service that's like $10,000 a month, and he will tweet that service first, before, like 5 minutes before he tweets everybody else. And I think that would be a worthwhile service. Maybe he'll do that. Who knows? So, all right. So what about 2007, 2008? So I've been trading full time since 1998, and I was actually trading before then. So I've been through a lot. 2007, 2008 was very scary, and it was very profitable. I truly thought it was the end of the world. My wife would make fun of me because the UPS guy would come with buckets of silver and gold. So at the peak, I had 25,000 ounces of silver, which is 1,562 pounds, and I also had 1,100 ounces of gold. So I bought the silver from $7 to $10 an ounce, leading up into the 2008 financial crisis. Again, I was convinced, and I was reading the doom and gloom newsletters. I was also trying to use some of my common sense, and it was just like, oh my God, the markets are going to collapse. We got to put everything into gold and silver, and so I did. And then what was funny is that the crisis passed, and I'll never forget, we're in the heat of the financial crisis, like it's the end of the world, and I had to go run out and get some stuff, and I went to Target, and the store was full, and guess what? People were buying stuff with dollars. Target wasn't taking gold. And so it kind of hit me. It's like, man, even though that there's going to be some crazy Armageddon type stuff, people still need to get toilet paper. They still need to get razors. They still need to get food. Commerce will continue to commence even if this other stuff is happening out there. And so it was a great way for me to kind of put everything in perspective. There's always going to be opportunities when there's chaos. If you take that opportunity and you convert it to dollars or fiat currency, With that fiat currency, you can go and buy gold, you can go and buy silver, and you can go and buy toilet paper. Okay, so that's the key, is understanding what's going to happen, how to take advantage of it, and then you can of course put your cash into anything you want after that. So the suburban pirate, exactly. So how to recognize market phases and adapt. So Richard Wyckoff, he was an early pioneer in technical analysis and is considered one of the 5 titans, along with Dow, Gann, Elliott, and Merrill. That sounds like a great name for a pub. He started his career in Wall Street at the age of 15 in 1888. Now you might think like, okay, well, why is that pertinent? And what's great about that is he was in the thick of things when the market manipulators didn't have computers. They were just like Jesse Livermore, J.P. Morgan, Jay Gould. These guys were larger than life characters. Remember, this was when there was no income tax on capital gains, and people were walking around with $5,000 and $10,000 bills. Okay, I collect those. They're fun. It's crazy. So he got to watch how these guys would manipulate stocks so that they could get into a large position without running it up, and get out of a large position without crashing the markets, because they were essentially the market. Guess what? He saw that firsthand, was able to document it, but now today that all the hedge funds and the computers all do the same thing. So the markets have not changed. Yes, there's more liquidity, but when funds are getting out of a stock, they're using the same principles to show that they're not getting out of a stock, because they don't want to create panic. They want to hand it off to the retail public. They go on CNBC and talk about how great a stock is while they're unloading it. That happens all the time. So there's 4 market phases that every trader must know, okay? And they are as follows. First is accumulation. So typically after a significant decline, the markets try to bottom out, institutions start loading up again. Then there's a breakout from this, and it's called an advancing stage, okay? The advancing stage is largely what we've had, and that's the classic buy the dip kind of a market, okay? Buy the dip. If you buy at the wrong price, be patient. We're going to make new highs, and you can exit then, okay? Then there's distribution. Distribution is when large funds start unloading stocks, but they don't want to drive the markets down. They want to make it look like there's still a chance that we're going to advance higher. Okay, but they are really in truth unloading their stocks, and at some point the dam breaks and we get the decline. Okay, now if you aren't aware of all of this and you like to just buy the dip, then during periods like this it's going to be frustrating, but you'll make a little bit of money. During times like this, you're going to kill it. Up here it's like, well, gosh, it just won't break out, but you kind of break even, and then of course here you get killed. So you want to be aware of this, because if we're in an accumulation market, there's setups that work great in that market. And if you're in an advancing market, there's setups that work great in that market and here and here. But you've got to understand what phase we're in, or you're going to be, by default, applying 75% of the time the wrong setup to the market that you're in, all right? And that's not sustainable. So these movements are easy to see in hindsight, okay? If we look at this, here's a 30-minute chart of the NASDAQ. So we can see, wow, that's accumulation, here's distribution, and here's declining. In hindsight, it makes perfect sense. The key is, if you're really going to be able to take advantage of these moves, is to identify it while you're in it, okay? Identifying it after the fact ain't gonna help nobody. So what is the opportunity here? The opportunity is to, first of all, understand the big picture of what's coming down the pipeline. Secondly, identify the 4 market phases earlier than anyone else, because even if there's all this economic stuff coming, it doesn't mean stocks go straight down, okay? There's still going to be a lot of volatility. There's going to be some micro advances within it. There's going to be markets like gold and bonds that are in full-on bull markets. So if you like to trade bull markets, guess what? There are plenty of bull markets out there, just not in stocks right now on the daily chart time frame. So first, identify those 4 phases, because each asset class will be in a different phase. Second, have a set of reliable setups and tools for each market phase. So the whole idea is, 1, okay, great, we're in distribution. then boom, what are my setups that work best in distribution? You've got to have that at your fingertips. So that's the kind of stuff that's really critical in this kind of a market. So how do you adjust to this? So the problem is that the market has been in an uptrend for so long that most traders, especially if they've only been doing this for a couple of years, don't know how to adapt to the other three conditions, okay? If you're trading a strategy that does not match the current phase, it is almost impossible to succeed. In the trading room, where it's much more flexible for me to be aggressive, change strategies, and do things that haven't necessarily been taught, and it's time to take that step and kind of document the strategies that we're going to be using more and more in there. So the key with this is to identify as early as possible which of the four market phases the markets are in right now. And then if you can figure out and read and notice the change from accumulation to acceleration, this is typically this is right here. That transition is the second biggest opportunity. And the biggest opportunity is going from distribution to declining, okay? That is where you're going to make the most money in the shortest amount of time if you can nail that transition. There's other trades throughout the entire process that are solid, but if you can nail those 2 times, you'll make more money during that phase than any other time during the quarter, any other time during the year. So knowing all this can bring you freedom and confidence faster than anything else, because now you're not relying on the news, you're not relying on the next tweet storm, you're not relying on outside forces to tell you what to do, to try to make sense of what's going on. Instead, you're just going to have the knowledge of what makes sense for a market phase and what setups works best, okay? And it makes it so much easier. So what's an example of this? So these market phases, of course, are going to happen in the larger indexes. The S&P 500 on a daily chart, on a weekly chart, the NASDAQ, okay? But they also happen on stocks. Now, Beyond Meat is an interesting one because this is one where all of this has unfolded very quickly. In the matter of weeks, it went through a phase of this whole life cycle. So here you've got a box, and it went through accumulation, acceleration, distribution, and declining in something like 55 days, whereas a normal market might take all year or 2 years or 3 years to go through that. So with this, what I do is, first of all, identify the phase that it's in, okay? When it was clearly identified that Beyond Meat, I call it Beyond Flesh, but Beyond Meat was in the accumulation phase, guess what? I pulled out my list of accumulation phase bets. Now, during that time, I'm not looking to make a killing, but I am looking to make money to PDB. Okay, you guys know what PDB stands for? This is a critical, it's called pay to bills, because you don't have to make a killing all the time, but you want to at least PDB. And in this type of a phase, there's all kinds of nice steady trades that you can do so you can pay the bills. And that's really critical. From there, though, when you see that it goes from accumulation into potential acceleration, I do what's called soft bets plus, okay? And this means they're still conservative, but with a little extra kicker, okay? And with my soft bets on that last slide, you saw I made $3,200. Here, I upped it up a little bit and good for $7,700, all right? However, when it goes into acceleration play, that is when you got to pull out the acceleration play playbook and change strategies. This is the only time that I'll buy out of the money calls. And in this case, you can see these out of the money calls made 332% in 5 days, going from 368 to 12, whereas these went up from 1520 to 38, about 150% gain. 10 lots on each, good for $31,000 in open profits, okay? So you can see that during accumulation phase, it was $3,200 with the capital risk. During accumulation plus phase, it was $7,400 with the capital risk, same amount of capital. And during the acceleration play, almost $32,000, the same amount of capital risk in each phase, okay? That's the whole key with that. So what is this and how do we look at it? So there's a couple of tools here that I think are important. First of all, for those of you that were in the March small lot class, I continue to look at things like ADX, you know, the 60-day channel, or the EMA stack positive or negative, but there's, and the VWAP, of course, but there's a couple of extra tools that help you with this. One is a VMA, okay? This is a color-coded VMA, volume-weighted moving average, specifically for helping to gauge where we are in the cycle. All right. So if price is above in gray, that's looking at accumulation. Green goes into acceleration. Here you can see accumulation, 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 boom, acceleration. If we're below in grade distribution, go to red, boom, declining, declining, declining. All right, so that's a huge part of it and a key tool, one of the key tools for trying to figure out where we are. Okay, so in addition to the 4 phases on your stock, though, you have, and that was just, okay, if I'm looking at Beyond Meat and I want to trade it, I got to know which phase it is, right? But in addition to that, you've got to know what the sectors are doing, because so goes the sector and so goes the index, so go most stocks. And I remember in the room today, somebody was asking me about what did I think of Apple. I said, I don't care about Apple. What do you think of the NASDAQ? All right. So goes the NASDAQ, so goes Apple. Okay. And it's really, really critical to understand that if you're trading a stock that's going to be influenced by the indexes, you've got to do the work first on the indexes or you're going to miss the boat. So from here, the other thing we want to keep in mind is that a lot of these indexes are leading indicators. New York Stock Exchange, a lot of people don't watch that. It's a first mover. Transports, a lot of people don't watch that. It's a first mover. And typically they're going to move before the S&P 500. Okay, so how do we do that? Well, one way to do that, you can sit there and like, these are 10X bars, and this is kind of what I did for a while, and it was an eyesore. This would be the classic time where, my wife would walk in and I'm staring at the computer and she's like, oh, you're not doing anything. Do you mind mowing the lawn? Okay, well, that's just kidding, because, but that kind of thing, where what I'm doing though, and she's listening to this, so I'm saying this very, very carefully, is what I'm doing though, a lot of times is I'm going through and looking and just saying like, okay, where are we? Okay, so we're, we've got distribution going here, but there's some accumulation in the NASDAQ. What are the financials doing? That's full on distribution, right? But over here, or full on declining, but over here is distribution. So you can kind of go through and see at a glance what everything here is doing, right? So, I talked with Eric about this and I said, please make my life easier. I cannot stare at the stuff, my vision's going, I can't stare at all those charts. And so he just made some more utility labels that say, look, if it's red, it's in distribution mode. If it's green, your acceleration mode. And then here you've got either accumulation or distribution based on its relationship with that VMA. Okay, so now it's a lot easier to look at. Okay, and it's just like I can add this to the dashboard, and now all of a sudden things get easier. Okay, so as an example, XLF in this case right here went from distribution to declining. We're able to buy puts, and in 4 days it was good for a 42% profit. Okay, and the diamonds, more importantly the indexes, went from distribution to declining. We were able to buy some puts on August 1st for 450, cash them out on the 5th for $9, 100% gain. All right, those are the things that if you're aware of it and you can pounce on it, you can make some really solid cash on that. Okay, so from there, so what is some of the stuff? So this is kind of what I have and what it looks like, where I can sit there and say, okay, great. So we're sitting here, Roku, this is an intraday chart. We're in accumulation mode. We've got a squeeze. And then once we kind of change back into acceleration, I can take a decent aggressive bet on this. And in this case, bought some slightly in the money calls at $100 calls at $4.35, and we're able to flip them out for 144% gain in 5 days. Those are the kind of things that we just want to be patient for and wait for. Okay, and when we see that and we can time it, we can, and especially with options, which, as you know, if you're buying an option, it's a deteriorating asset, it can make a big impact. Okay, Netflix, this is a great strategy for income. If you get us, and Amazon, by the way, is doing the same thing. You break down, you're in full-on distribution mode. Any rallies to the EMA, you sell a call credit spread. Okay, you just keep doing this all day long, and this is an easy way to do what? Get money to PDB, which is pay to bills. So this 10-lot trade, and again, if you're newer to options, you're like, I don't understand what this means. It's fairly simple to do once you know how to do it. But on something like this, so if you think of it this way, if you buy a 320 call, so in this case, say you buy the 320 call at 381 and your goal is to sell it at $5, well, that's how you're going to make money. But have you ever bought a call for 381 and it drops down to 20 cents? And you're like, man, that didn't work out. Well, guess what? Whoever sold it to you made that money. Okay. So think of it, when you buy an option and lose money, that you didn't really lose it. It's just flowing into someone else's account. So when you can identify those opportunities where it's like, man, whoever's buying calls here is going to get ripped off, you can take the opposite side of that trade. And so we always do this as a spread. So there's no there's no unknown risk. It's quantified risk. So here I sold 10 contracts for $1.56, which is $1,156 credit, and then basically cashed it out. So that kind of stuff is nice because with options, it's pretty easy. So the key was something like this too. Of course, if you're watching the news, and I remember this, I was traveling when this happened. In fact, you had this huge 50-point up day on a tweet, and then the next day it was 80 points down. This is an amazing day. But if you're watching the news and tweets, this is the kind of price action that can drive you crazy because you're not expecting that kind of movement, right? So, but again, however, if you're looking at the right tools, now that you kind of understand all these phases, look at this now. Okay, so here's what this happened. This was the big up day. All we did was rally back to the grayed out VMA, which basically says, you know what? We are under distribution. You sell that pig, and you can see the next day, all we did was come right back down to the box. Okay. All of a sudden, this roadmap becomes a lot more clear. Okay. This is not, oh my gosh, we have to buy this, we're going to make new highs. Okay. Not in any way, shape, or form. So suddenly you get a roadmap that makes this whole picture a lot easier. Okay. So the market action is often determined by extreme internals, namely the trend and the put call ratio. Okay, so let's take a quick look at that too. So the trend, by the way, does anybody know where the trend closed today? The trend, if it has a reading over 2, 8 times out of 10, you're going to have a huge rally the next day. Okay. However, if you get 2 or 3 in a row, it often leads to a market crash. Now today, yes, today the trend closed at 0.50. What happens when it closes at 0.50? You typically get a sell-off, okay, because that's a true overbought reading. So we did have a nice rally today, but we had a rally today where the trend ended at 0.50. I would expect, okay, and there's never 1,000% answer that something's going to be correct. It's all about probabilities, right? But typically there's going to be an 8 times out of 10 chance that the markets are soft tomorrow. It doesn't mean that they roll over and die. You know, the S&Ps are down 6 after hours right now, but maybe they retrace some of today's move. You know, who knows? But the main point is that's important information to know. From there, the next piece of important information to know is the 10-day moving average of the combined index to equity put call ratio. If it's down here, everybody's long. If everybody's long, there's nowhere to go but down. If it's up here, everybody is short. If everybody's short, there's nowhere to go but up. Okay, seems kind of contrary, right? It is. If everybody on the planet owned Apple and there's no one else left to buy Apple, the only way Apple's going to move is down. Okay, it's going to take out the little stop, the tight stops first, but when a stop is hit, that's real selling that drives it lower into the next set of stops. All right, so that's how it works on both sides. So same thing here. You know, as we got into August, oh, everybody's long, so we were expecting that decline. So that's what I want to know. Where are those extreme readings? So part of the tools that are included with this class are new utilities that include the trend. Okay, there's your trend reading, the actual put call ratio, and the 10-day moving average of the put call ratio. So they're front and center. Okay, in addition to things like, are these moving averages stacked, and where's the VWAP, and you know, in addition to all these utility labels down here as well. So now all of a sudden we're getting a complete picture, so we can be more aware of these large moves that are coming right at us. Okay, so the key here is to focus on key variables. The best traders are incredibly versatile. They can be short bias, but still capable of going long without hesitation. All right. At the end of the day, hesitation, especially during these conditions, will rob you. Not only will it rob you of potential profits, but literally rob you. Like other people will suck money out of your account. So if you focus on key setups that work in specific market conditions, then the faster you can identify which of those 4 market conditions we are in, the more consistent your trading will be. All right. Now, I talked a little bit about those quieter markets, right? You guys remember accumulation and distribution. I call those the 20% moves. I'll do these 20% moves all day long. What does that mean? That means buying options for 15 and selling them at 18. Okay, that was a 17.6% move, but you're catching my drift there. I'm not looking to buy options at 15 and sell them at 30. I'm going to get my 20% and move on. Okay, again, PDB, pay the bills, get my $2,600 and move on. But the key is, if you know you're in that kind of a market, then you're not going to get falsely excited about the potential for big gains that ain't going to happen, right? You're going to be happy with, oh, I'm going to buy options at 15 and sell them at 17, or I'm going to buy options at 5 and sell them at 5.75, because that's how you make money in that kind of environment. Okay, but where a lot of people really get frustrated is they're going to say, in a nice advancing market, you can buy options at 5 and sell them at 10. But if you try to do that in a accumulation phase or a distribution phase, you're never going to get your target hit, and you're going to lose money on premium decay, and it can be very frustrating. Okay, so if you know what phase you're in, boom, you go to 20%. I just call it the 20% gains. Get your setup, get your 20%, and get out. Now, even though that the markets can be shaky, while the markets were going down, TTD had a great move to the upside. So if you have a larger account, you can do that with stock. We did this one with stock. It was good for $26,000. And in this case, the stock went from about 260 up to 285. Okay. So again, the point here is that, yes, you want to know what phase the indexes are in. You want to know what phase key sectors are in, but there's also going to be individual stocks that are doing their own thing. And you can also use these tools to identify that. You can identify the honey badgers. Okay. And of course you can identify and say, okay, well, what's gold? What phase is gold in? What phase are bonds in? What's oil in, et cetera, et cetera. So the key to consistency: in order to consistently make money, a trader has to learn how to create steady winners off their trading account by learning to identify which of the 4 market phases we are in right now for the indexes, okay, and stock in question, know which setups work best for the various 4 market conditions, and be willing to rotate through those setups without overthinking. That means do not get married to your position. You may start off going like, okay, I'm buying calls here on TTD, and it's under an accumulation, or it's in an acceleration phase, so I'm looking to double my money. But every day you got to wake up and be willing to change your mind and say, ooh, wow, based on these key things, it's no longer an acceleration. It's actually gone into distribution. I need to lower my expectations drastically and quickly. Okay, change without overthinking. And that's a tough thing to do, because what happens, human beings, when they make a bet or when they commit to something, then there is this dichotomy that automatically kicks in, that they then must act consistent with their decision. Okay, and that destroys more traders than anything else. As an example, at a horse race, you walk into a horse race, there's 10 horses. You know that any of those horses could win, but the moment you make a bet, you become convinced that that one's going to win, and you won't change your mind, because you'll now want to react in a way that's consistent with the decision that you made. This causes more people to lead lives of suffering than anything else, because they all want to justify the decision that they made. And in trading, you cannot afford to do that. In trading, you've got to, when you make a decision, you got to know, you got to hold that. The whole key with trading is to have convictions that are loosely held. Okay, convictions that are loosely held. They've got to be able to change as the data changes with it, and don't fall into that psychological trap. So the key to consistency here, of course, I love the squeeze. For those of you that are familiar with my work, you know that the squeeze is one of my favorites, and it does work really, really good during transitions. But guess what? During a fast declining market, it's too volatile for squeezes to set up. Okay, so you got to learn how to trade a down market, because they're way, way, way different than trading an up market. So when the market is in declining mode or acceleration mode, a lot of times no squeezes will appear because it's too volatile. Okay. Now I've got a book out, Mastering the Trade, and Mastering the Trade does talk about things like squeezes and stuff like that, but it does not talk about these market phases. It does not talk about how to do that kind of stuff. So the question and the key with something like this is that there are many simple ways to stack the odds in your favor, and especially if you're trading a small account. And I'm going to discuss these principles in detail, as well as my proven technical strategies for each market phase in this upcoming workshop I'm going to hold on Saturday online. Now, I want to show you some of the tools that are included with this. We'll come back to that slide. So the first thing is for these updated utility labels, okay? So this thing with the trend and the put call ratio and all this kind of stuff, they'll be added to your library of utility labels. Plus, we're going to have all the utility labels down here that'll help show you at a glance what phase it's in, plus our coded VMA to get a sense of where we are, okay? And so all that together is going to help. In addition to that, I'll also show you how I use some of the premium tools that we have. I know a lot of you guys are like, oh yeah, the RAF is awesome and 10x bars are awesome and maybe Credit Sniper and a few other ones. And I'll show you how I construct that, because we've got other tools that are out there, and I don't want you to think like, oh, are those tools obsolete? Absolutely not. I'm going to show you how I incorporate them in there. But if you don't have them, that's okay. And then last, guess what? There are ways when a market is heading lower, you got to manage it differently. So there's a few tools like the 2-day rolling pivots. All right, I use those to help manage these down moves, because a lot of times, guess where the moves end, right? So that's the kind of stuff where if you aren't aware of that, you can actually get whipsawed quite a bit. Now, for those of you that did the small lot class with me in March, and for those of you that are in the small lot alerts, you guys have special consideration and some discounts that are automatically set up for you. Okay, so if you want to join me in this workshop on the 31st, if you were in my March class, you get 20% off the Pro and Elite packages, which include the live trading. Okay, and if you're part of the Small Lot Mastery workshop or alerts, you actually get 30% off the Pro and Elite. All right, so with this, you get the ability to spend some time in a live trading environment and the comfort of your own home learning this stuff, plus obviously access to the tools and all that kind of stuff if you want to do that. So, and the discounts applied automatically. A nice feature with this is that we've also set up PayPal credit. Okay, what does this mean? If you choose the PayPal option, choose PayPal credit, you can do 0 down and no interest for 6 months. So we've had some people did this with the last class where they do that. And then of course there's no guarantees because it depends on a lot of stuff, but I've had emails back from people who said, wow, and then I was able to make money during the class and apply it to this, and that's great. And it's really been great that PayPal did that, because it's no interest, it's 0 down. At the end of 6 months, if you haven't paid it off, obviously some interest kicks in, but you can still just make payments and stuff like that too. So that was really cool. So what are we going to cover? My favorite strategies for consistent gains, even without a strong uptrend, but more importantly, taking advantage of this kind of coming economic crisis. And believe it or not, during the Pro and Elite course, we're going to spend 2 hours on that just outside of market hours. Okay, and I'm going to talk more about that in a minute. How to master all 4 market phases and enjoy that process. How to know when each market phase changes and to be positioned to profit from that. Proven setups to turn volatile moves into quick and reliable cash flows. Okay, it doesn't all have to be big gains. All right, I want you to think PDB. You got to pay the bills. The early warning signs that blink almost before every stock market crash, and how to build lasting wealth by staying ahead of the biggest economic trends. All right, that's huge. And the strategies I talk about, if you're newer, that's fine. If you got a small account, that's fine. This, the stuff isn't complicated. There's no naked selling, so it's safe strategies. There's fixed amount of risks, and you don't need to know about the deltas or gammas or vegas or anything like that. Okay. Some of the bonuses included. There's a quick start class that gets you up to speed on my general philosophy of trading. Okay, an options 101 course if you've never traded options before, plus a lot of the tools that you saw discussed here as well. So now let's go to this one. Okay, so what is this and how does it work? So Saturday the 31st, I'm going to do this class. The actual class is from 12 to 4. All times are in Central, and then at 10, we're going to start with some of the bonus stuff and things like that. So this will include the strategy, all the 4 market phases, the different setups. There'll be the quick start class, options 101, and of course the workspaces. All right. If you want to do some live trading with me, which I recommend, because here's how this works. If you've never played golf before and you got to play with your boss on Monday, so you spend all weekend cramming with books on how to play golf, you're going to show up on Monday and you're going to be horrible. Why? Because you never got that practical experience of actually swinging the club in front of a golf pro who could tell you what you were doing wrong. All right. Loosen up on the club. All that kind of stuff. So it's a unique experience where we can trade together. You'll be in the comfort of your own home and you can just ask questions. It's always easy to see something in hindsight, but when the shit's really going down, how do you know whether or not to pull the trigger? That's what the live trading is all about. So I'll be trading my account live. I'll show you all the trades I'm doing. Front and center, you'll watch me make money, you'll watch me lose money, see what I do in both situations. We have had a pretty solid record of people being able to pay for the class with the trades made during the workshop. All right, can't guarantee that, but that has definitely been the trend. The bonus with this is I'm going to be doing the macro deep dive. This will be about 2 hours of discussion. Essentially, where is the economy headed over the next couple of years? We're going to be talking about negative yields, inversions, yield curve inversions, all that stuff. What does it mean for real estate? What does it mean for stocks? Where do you put your savings? How are you going to retire on a negative yield? All that stuff, okay? No reason to panic because there is going to be some nasty crap coming at us. But as long as you understand it, you can position yourself and your family for it, and you can trade it. So this macro deep dive, yes, there's going to be trading, but it's also things like, where do you put your money, right? Is real estate going to crash, or is that going to be a good place for yield? Where is the next bubble going to be created, okay? Because it's going to change all of that stuff. And so that's going to be pretty amazing. And then, of course, we're going to have 2 live trading days. And then the elite is simply the premium and the basic plus another 2 live trading days 2 weeks later. And the reason we split it up 2 weeks is to hopefully get different conditions. And we're going to do monthly expiration, which is always fun. Okay. Let's see here. So the link that you type in is simplertrading.com/secret. And again, this will be a little sloppy here, but this is going to be on the 31st. This will be on September 4th and 5th during market hours. And then this will be September 19th and 20th during market hours. And this will be on the 3rd. Of course, any of the stuff that you cannot attend live, it will be recorded. All right. Yeah, and also keep in mind, if you can't make it, it will be recorded, and a lot of times people will have similar questions. Okay, so if you're not there to ask questions, somebody else there will probably ask a similar question, and I'll answer that. So you'll get a good sense of that. Plus, of course, you can always email us after the recording. And what time is the deep dive on September 3rd? I believe we're going to do that after the market close on the 3rd. Tracy is asking, how long do the live trading sessions go for? And I'm in Australia. Okay, so I know your hours there are going to suck. But we'll trade during the entire U.S. market, cash market session, which Central Time is 8:30 a.m. to 3 p.m. And I know that's super, super weird hours down under. Do any of the indicators come with the class? So yes, so not the premium ones, and you may not know what that means, but what'll happen is you saw that there's some what I call utility labels. Those come with the class. That VMA, that comes with the class. If you have Thinkorswim, which I do recommend, that's the easiest. There's also some tools on there that we use, and we'll get you all set up for that. And if you don't have Thinkorswim, if you use this link, I'll post it here in the presenter post, simplertrading.com/toss for discounted commissions on Thinkorswim. So the thing is, I know some of you guys have Schwab and E-Trade, and I have nothing against them. It's just that we can't create our tools for them. So what a lot of people do is they get a Thinkorswim account. Guess what? It's totally free. They don't charge you for data. They'll put our tools on Thinkorswim, and then they'll still execute on Fidelity or Schwab or E-Trade. The only thing you have to do with Thinkorswim is just deposit some money, like $100 into your account. It's your money. They don't charge a monthly fee or anything like that. And then you'll have access to real-time data, scans, all that stuff. So that's kind of, I mean, you know, there's other, you know, we have done a few things for TradingView, but not, you know, not a lot. I love TradeStation. We've had a hard time making utility labels for TradeStation. So I use 4 main brokers: Thinkorswim, TradeStation, Tastyworks, and Infinity. So we're broker agnostic. We don't care who you use. It's just that our indicators, we've just found that it's easiest to develop them for Thinkorswim right now. Oh yeah, cool. Okay. Yeah, so DSI. So what I will end up doing is incorporating some of these same signals into the small account mastery. Yeah, so we'll just to make it easy. And let's see, the live trading for premium is the whole trading day. Yes, so good question. So for the premium elite, the live trading days will be during market hours. So for Central Time, the cash session is 8:30 to 3. We typically will take kind of a longish lunch, like 90 minutes or even 2 hours, just because in the middle of the day, there's not much to do. Plus, it's good to take a break. And that's part of my trading routine too, where, you know, if you stare at the markets all day, what happens is a lot of times if you stare at the markets all day, a very solid habit for day traders is they make money in the morning and then they give it away in the afternoon. And the reason they give it away in the afternoon is because they just simply become tired and impatient and they can't make any more decisions. So it's important to take a break, go to the gym, go for a walk, stay hydrated. So the trading day will kind of reflect my own routine. Does it work on all commodities? Yes, Stan. So currencies, gold, you know, just it's really because what it's based on is the underlying price action, right? So it's kind of I'll see if I can grab it here. It's kind of agnostic when it comes to what it's looking at. It's just kind of measuring like, is this thing, you know, what phase is this in? You know, is this in a phase here that's under distribution or et cetera, et cetera. It's also time frame agnostic. I mean, I think the daily is one of the most important. You know, if we look at the S&Ps right here, of course, you know, today we had a solid up day, but we're certainly still under distribution. But then if we go and we look at gold, the story changes, right? So in gold, we are full on accumulation mode, okay? So how do you trade that? Like, doesn't it seem extended, et cetera, et cetera? If we look at the 30-year bond, you know, full on accumulation. If we look at a stock like Roku, right? Roku, I want to buy a pullback on Roku because it's such a strong stock. Total accumulation. Shopify, you know, how do you trade something like Shopify when it's not only under accumulation, but it also seems like it's a little extended, right? Well, we're going to talk about that. JB is asking, are you also trading futures in accumulation decline phases in this course? Yes. So good question. So here's the types of trades I'll be doing most. So we'll be focused on shorter term trades, not necessarily day trades, but we'll do some. The trades that I like to do during the class typically are trades that would last a couple of days to a couple of weeks. So if you're trading a small account, don't worry, we're not going to violate your day trading rules there. And then from there, and for futures, I do like to do S&P futures, NASDAQ futures in particular, but we'll also look at some other ones as well. The futures are typically either shorter term trades, but we'll be looking at this as well. Another stock here, oh, Netflix. So this is a stock I keep trading. Look at this, total distribution mode. All right, total distribution mode. And it's really been a solid one. So a couple things like that. Okay. Oh, so we do have a trading room. Yes. So if you aren't in our trading room and you're not familiar with it, what we typically do is give everybody a trial to it, so you can at least check it out for like 30 days. That's kind of like where we all hang out and compare notes. Today was just kind of like a quiet day where you just want to take a hammer and pound your head in. But while that's happening, we can all have discussions in the trading room, and so it's nice that way. Yeah, and it's a good group. Awesome. Terry, I just registered for the class. I was told by your support that the VMA would be made available for TradeStation. Is that correct? Yes. So there should not be any issues in programming that for TradeStation. The only thing, typically any tool that we build in Thinkorswim, we can also build in TradeStation. The main exception has been utility labels. So there's some workarounds for that, but that has been difficult. That's been the only difficult thing for TradeStation. What is the difference between distribution and declining? So good question. So let me see if I can just find an example, since I'm just looking at Netflix here. So here's an example of accumulation and then advancing. And then I think there's an example of, let's see. Yeah, and then distribution, and then declining is when you get a combination of two things happening together. So you're just kind of looking at some different things like that. Distribution, and then boom, declining. So yeah, so you just kind of, so that way you can just kind of recognize it right away, whether it's a stock or an index, et cetera, et cetera. Fred is asking, will you go into detail on how to accurately read this indicator and make tradable decisions based on what you think the chart is showing? So Fred, that is a great question, because that is exactly the goal of the class. So at the end of the class, my goal is that you come out of that and you are no longer in a situation where you're looking at the screen and you're wondering what to do, okay? You're gonna have checklists, you're gonna have specific examples, and it's gonna be fairly, it's one of those things that it could get really complicated, but a really big lesson I learned is there was one summer where, a couple years ago, where I had a niece that was kind of interning and trading, and the only way she was successful is when I drilled it, when I put together a trading plan that was half a page long. Originally, I gave her one that was 5 pages long, and when I drilled that down to bullet points and half a page, she was successful because she had a blueprint to follow. And so I've taken that lesson to heart. And so when I do a class, and look, when I'm talking about a class, I'm very passionate about this stuff. So I'll dive in and talk about all this kind of stuff. At the end of the day, here's your checklist. And that's the goal with that, because I know that, I've been doing this for a long time, and I can kind of look at stuff and, remember, oh yeah, when that happened 10 years ago. But if you haven't been through that, I want you to be able to kind of pick up an index card or print out the Word document and say, okay, we're in declining mode. This is what I need to do. Is distribution and accumulation treated the same? That is a great question. And so the answer is no. So during distribution, so if you think of it this way, during distribution, there is more selling pressure, right? So we want to do setups that take advantage of it. Whereas during accumulation, there's more buying pressure, and we want to take advantage of that too, even though they're both trading sideways. Even though they're both trading sideways. Where do we ask? Tupac, when you type like that, we see your question. Yeah, so we do. I mean, we do have a couple. We do have a room. That's just. It's basically an all-day webinar during market hours. Yeah. So some of the tools here that are in this. So here's just a live chart. So the tools are. We've got a VMA here that's specifically modified to help you with this. All these labels down here that you can actually modify to whatever you want, but those are that's what I look at specifically. These are new utility labels up here, in addition to all these up here as well. The squeeze is something that's on Thinkorswim. We have a Squeeze Pro, which is a little different. So we do have a few other things like that. And all right. Excellent. All right, guys. Well, I think that sounds like a lot of good questions there. I'm gonna write the dates up here again real quick, and with my 3rd grade handwriting. So this will be August 31st. This is September 4th and 5th. You don't want to miss this, and that's going to be September 3rd. And then here is going to be September 19th and 20th. And then remember, if you did for premium and elite, you get 20% and 30% off if you took the March class, the small lot class, or you're an alert service member. And then last, keep in mind, PayPal, 6 months, 0 money down and no interest. Okay. Oh, Dave, good question. Is everything based on daily charts, or do you drop down to an hourly chart for trade exit? So Dave, so I start out, the daily chart's kind of my default. In terms of a setup, we'll do kind of both, because you can absolutely just focus on the daily chart, especially if you're working full time. You know, you don't actually have to drill down to a 30-minute chart and try to time it. However, I also like to look at intraday charts as well. So we'll kind of do a little bit of both. We'll say like, all right, here's a daily chart. Now, if you're working full time, this is what you do. And since we're all here together, let's drill down a little bit and see if we can time a trade on this. Also, oh yeah, so good question. So if you sign up for the live trading, but you can't attend, will you get alerts of the trades to your phone? And the answer is yes. So that's, yeah, that's a nice kind of a perk. Yeah, we do have, we do have a trading room. We do have a trade alert service. You know, on Saturday when we're all together, I'm happy to kind of give you as many, you know, details and all that stuff as well. Just kind of like some of the additional resources and things like that we have. John, will this class finally help me find a date? Bo, absolutely. You'll be able to have sparkling conversations at dinner that will help you take that relationship to the next level. Yeah, my wife just said, yeah, it worked for me. Because, you know, when you start talking gamma, women cannot resist that. Let's see. Oh, Brad, that's an awesome question. Okay, so if you're already a member of the options trading room, is the live trading going to be much different? So the answer to that is yes. I guess it's hard for me to completely explain it, because I'll talk to people that are in the class, but here's the best way I can explain it. In the room, it's kind of like, hey, the markets are moving. Here's some setups. You know, today I was in the room. We bought some call options on CRWD, and then I closed out a call credit spread on Netflix. Okay, and that was it. And then we just kind of shot the crap for a while because there wasn't much to do. When there's a class, we are specifically, first of all, we're together for like 5.5 hours instead of 1. And we are doing a deep dive into the strategies for the class so that you can fully understand them. So whereas a normal trading room session's like, all right, here's some setups that I found, and we're going to take them. This is more about pure, we're doing trading backed by a ton of information and a ton of education. Some people that have been clients with us for a long time, they take every live trading class because A, they make money during the live trading class, and B, they always learn something new. Plus, they just have a passion for trading. And so I think it's one of those things too, when I know personally, when I'm taking a deep dive and teaching a class, I mean, I'm well rested. I bring my A game. And the only reason I teach a class is a lot of times because, you know, like the big picture outlook. I do a big picture outlook because I want to find out what's going to happen next. So it's kind of a curiosity thing there too, where it's like, all right, well, if I'm getting, you know, that's a motivating way to kind of really dig in and get access to all the contacts I have and put something together that's not only useful information for me, because I learn from it, but also for obviously everybody else. Can you explain the difference between the pro and elite trading days? Yes, so all that is that with the elite, you get an additional 2 days of live trading. So with the pro version of the class, there's 2 days of live trading plus the Saturday class, and in elite, there's 4 days of live trading plus the Saturday class. Oh, Rick, appreciate it. Rick's just saying, I've been with you guys for a long time, and every class is something new and useful. And that's great. And Rick, and I hope you'll tell me, because at some point, if you ever take a class and you're like, John, that was the same as last time, tell me, because at that point, I'll hang up the hat and just trade. Because the only reason to do a class is like, hey, the markets are changing. Here's some updated information. And the markets are constantly changing. You know, the moment in trading that you think that you know it all is the same moment that the markets are rearing back to pop you right in the face. What is the quick start class? So the quick start class is if you're kind of newer to simpler, newer to my style. It's a quick start is just a basic philosophy, my basic kind of point of view on how the markets work. Here's how they ebb and flow. This is why squeezes work. This is how you time it. Just like that too. Yeah, the SPX trade today was like, oh God, it's gonna no. That's true. That's true. No, there's always well, part of this process too is certainly documenting the classes, right? So we record everything. All right. Let's see what else we got here. All right, I think we're good. So I'll leave this up here, guys, and keep in mind this is the link. You just got to type it into your browser. You'll come up with this page, make your choice. You could give us a call here at the office, 512-266-8659. And of course, you can just email us at support and support@simplertrading.com. So I'll just put up here support at, and of course, simplertrading.com. Oh, that's awesome. Just telling Danielle, I attended her Stacking Up Profits course and I really learned so much. Yeah, that's awesome. That was a fantastic class. All right, guys. Fantastic. Well, thanks for joining. Look, it's not going to be a dull rest of the year, and frankly, it's not going to be a dull 2020. This is the class that's going to get us all ready for that. We can learn about it together, and it should be a lot of fun. You guys have a fantastic evening. See you guys. For those of you in the trading room, I'll see you tomorrow morning. And then otherwise, and remember, we got a long 3-day weekend coming up, which is actually works out pretty good because then we get the Saturday class and we still get 2 days to recover, which is amazing. So that's great. And you guys have a good one. Looking forward to working with you on Saturday for those of you that are joining, and obviously for the live trading. I'll leave this up and we'll be sticking around if you guys have any questions. But otherwise, have a great night and see you on the other side.